Top of the morning to you, and welcome to our newest episode of Capital Markets Quickie from MVP Mind Value Partners. The U.S. stock market had another record-setting week with all major U.S. indexes hitting fresh all-time highs. Fiscal stimulus optimism was great for the stock market, but also for gold and silver. And long-term Treasury yields rose modestly, oil logged its seventh straight weekly gain, and the U.S. dollar continues its downward spiral. My name is Endrit Cela, coming at you from Frankfurt, Germany, Europe's financial hub and home to the ECB. Let's take a closer look at what moved the markets this week. Even though we've heard this countless times, it seems as if U.S. Congress is closing in on an agreement on a relief bill worth $900 billion. At first, there were talks of a larger bill, larger than $2 trillion, and with time that amount just kept shrinking as Democrats and Republicans could not seem to find common ground. But as we all know, fiscal relief will add the needed boost to the economy next year, and a near-term deal seems to be in sight. This stimulus bill is said to include direct payments for Americans, $300 billion for Paycheck Protection Program (PPP), and a $300 weekly federal unemployment benefit. So obviously the stock market loved this news, and the rally continued with all major US indexes breaking their previous records. And well, that's also due to monetary policy stimulus that will continue to remain a powerful tailwind into 2021. We also heard from Fed Chair Jerome Powell last week, who commented that the Fed will be keeping interest rates low for an extended period of time. Moreover, the American Central Bank will continue to tweak its approach to monetary stimulus, announcing last week that it will tie its asset purchases to economic outcomes versus defined timeframes. Now that is an interesting turn of events. That means that until substantial improvement in unemployment and inflation has been achieved, the Fed will continue to buy more than $100 billion in assets per month, which will keep rates low and inject money into the economy. So I guess you can say the patient is being kept alive with all kinds of injections, fiscal, monetary, and soon vaccines. And pretty soon the patient will be able to get up and walk out of the hospital. However, it's not all funs and giggles. Even though there is plenty of liquidity to go around, this combination of an additional stimulus package along with additional bond buying and asset purchases from the Fed clearly drove gold and silver prices much higher last week and drove the dollar to new lows. Silver closed the week nearly 8% higher at $25.81 an ounce, and gold closed the week 2.39% higher at $1,882 per ounce. But the ICE US dollar index DXY, or DXY, which measures the currency against a basket of 6 major rivals, slumped 0.7% to 89.828, trading below 90 for the first time since April 2018. So it's down 6.8% so far this year. And if we take a look at the euro-dollar ratio, we'll see that the euro has gained 9.3% on the dollar this year alone. And as I've mentioned in my previous podcast from 2 weeks ago, historically speaking, the US dollar is a safe haven for investors in times of crisis like this. But this year continues to be a rough year for the dollar. And many analysts expect things to get a bit bumpier before relief is on the way. I do believe we are in the initial stages of a new expansionary cycle, but the recovery is likely to crawl and maybe even stumble a few times before it will run. The stock market is sitting at record highs, but that is not unreasonable as equities are pricing in the anticipation of the economy recovering much quicker than expected next year. But you should remember, as expectations remain high, the cushion against potential disappointments is always a bit thinner, and investors should anticipate more volatility as we turn the corner into 2021. That's why at the end of the day, it is important to keep a well-diversified portfolio that will help you weather any kind of storm that may come your way. And that, ladies and gentlemen, concludes today's Capital Markets Quickie. I'd like to take this moment to thank you for listening to my podcast every Sunday. I hope this has been as much fun for you as it has been for me. I look forward to another exciting year on the markets, and most of all, I look forward to taking you on this journey. To all of you listening from every corner of the globe, I wish you all the best and stay tuned for our last episode of this crazy year on Sunday, December the 27th.